Welcome to the Financial Modeling Teacher, Portfolio Selection Techniques, Part 1 of the lecture series. At the end of this video, we will understand how to explore the principles of portfolio optimization and its significance in investment management. We will discuss the role of quantitative techniques in constructing efficient portfolios. And we will understand how to select optimal asset allocation and manage portfolio risk effectively. Now, defining portfolio selection, we say it aims to construct portfolios that maximize expected returns while maintaining acceptable levels of risks for individual investors. This involves using historical data and investor expectations to model expected returns and acceptable risk levels, ultimately aiming to select an optimal portfolio. It is referred to as the mean variance portfolio analysis. It is actually a normative theory. In other words, it means that it describes the standard or normal behavior that an investor should pursue in portfolio construction rather than predicting the actual investor behavior. Let's define the quantitative techniques that are used in portfolio selection. The capital asset pricing model, also commonly known as CAPM, is a widely used model that relates the expected return of an asset. The expected return of an asset with the market beta, which is a systematic risk, against the expected return of the market. Okay. But now they are connected by the risk-free rate, as we can see, the expected return minus the risk-free rate. While here in this relationship now, risk beta, which is that one, it's a sensitivity or it's a measure of a systematic risk. In other words, the risk that is specific to the asset itself. Or it could be something, let's just say, all the mining stocks are affected by the sector, resource sector beta. Financial services might be affected by financial services beta, etc., etc. Now, the Sharpe ratio, on the other hand, it's a risk-adjusted portfolio measure. In other words, consider both the expected return and the volatility, in the sense that the expected return here, as we say, the expected return is that portion of the expected return from the market less the risk-free rate. That's what we call expected return, but all over the portfolio volatility, which is a sigma p. So in other words, it measures the sensitivity of the portfolio's excess return to the portfolio's volatility. The trainer Sharpe, or even the trainer measure, on the other hand, is the same analysis as the Sharpe ratio, in the sense that we have that from that excess return of the market, the denominator becomes beta itself. So meaning that the trainer measure, it's more to focusing on the individual stocks within the portfolio. So in other words, it will measure the sensitivity of the excess return to the portfolio beta. So the Jensen alpha, on the other hand, is the alpha as a measure of the overall portfolio against its benchmark. For instance, the alpha, which is positive, indicates that portfolios outperformed the market after adjusting for systematic risk, while negative alpha suggests underperformance. So last but most importantly is that there follows optimization in order to find the optimal allocation of the portfolio given the respective weights. So there are methods such as quadratic programming, linear programming, or even the Monte Carlo simulation that can be used to find optimal allocation that maximizes the portfolio return while minimizing its risk. Before introducing the mean variance framework, let's take a moment to revise matrix multiplication. This is a fundamental operation in linear algebra that involves multiplying elements from two matrices to produce the third matrix. We use the matrix notation where a bold capital letter represents a matrix. So in our case, we have, for example, matrix A and B, where a matrix A has a dimension m rows by n columns, and a matrix B has got n rows by p columns. Resulting matrix C from multiplication has m rows by p columns. So that now the individual entry ij, resulting matrix C, as denoted by a small cap Cij, C subscript ij, being an element of that matrix, is calculated by taking a dot product of the ith row of matrix A and the jth columns of matrix B. Mathematically, this can be represented C, matrix C, is equal to a dot product of matrix A and B, or rather a shorthand, or expressed in terms of individual elements. We see that we have a summation sign, meaning that it combines all individual elements by row and column, We can see that the common denominator here is columns. So these two matrices will have the same column. In other words, for the other matrix, the number of columns should be equal to the number of rows on the other matrix. As you can see, we have A, Ik, but here we start to say B, Kj. So now where A has got I row, K columns, we would rather on the other matrix have B as K rows by J columns. So just to sum up then, we say matrix A, big capital letter A, it's nothing but just a combination of elements Aij, all giving rise to an M row by N column first matrix. B being a combination of elements Bij, resulting in N row by P column second matrix. And then after multiplication, the resulting matrix C, which is a combination of small elements C, row I, column J, resulting into M row P column matrix C as a result of this multiplication of A and B. Now, here's a simple example where we have, let's just say, matrix A with those entries. And matrix A has got only 2 columns, while matrix B, on the other hand, has 3 columns but 2 rows. So meaning that standard rule with multiplication of matrix is that one matrix should have the same number of columns as the number of rows in another matrix. So that now the multiplication will go like this. Let's start with the first column will come to this entry. This entry in this second column will come to that entry. The entry in that will come to that entry, and then that entry will go to that entry, and then the last one will go to the last column and first entry, and then the remaining one will then come here. The 5 will come to here. So this process will give us those results at the bottom. What that means is that after multiplication, the resulting matrix will be a C matrix, which will be a 3 by 3 matrix. Now let's define the asset return. A simple return has got the formula R equaling to VF minus VI all over VI. Let's just say we can also say P, let's say T minus PT minus 1 all over PT minus 1. In this case, suppose that PT is the current price at period T, whereas T minus 1 is the previous or the most recent reading or price. So in this case, then in our notation of VF and VI, then we will say the return R is the return itself on the asset, and then VF then will be a final value of the asset. This could be an ending price, the ending market value, where the VI is the initial value of the asset, that is the starting price or the closing price of yesterday, and or even the starting market price itself. But alternatively, this analysis, we can use the log returns, where now we'll have the ratio of the final value over the initial value, then from which we work out the natural logarithm. So in the case of the notation where we have price T as today's price or the current price divided by the previous price, that is T minus 1, we have that ratio. Normally people would use this ratio for a simple return. Again, if you look at this way, it means we subtract 1 to be left with a decimal, or which can easily be converted into a percentage. Or alternatively, without the 1, we could have the same relationship or the same ratio, but instead of using multiply by 1, we now apply the logarithm thereof. Now coming to the portfolio return. So let's just say we have a portfolio where we assume that we denote it as R subscript P, P being portfolio. R is a return, as we discussed earlier on. And let's say it's a 2-asset portfolio, each one with a weight. So now this would be portfolio W1R1 plus W2R2. So really here, W1 and W2 are the weights of both asset 1 and 2 respectively, while the R1 and R2 are the asset returns of portfolio of asset 1 and 2. Sometimes, let's just say, or in most cases, the W might be given in your solution. Or let's just say in some case where we only know one asset to be, let's say, weight X, but we have a 2-asset portfolio. Let's say this is W1. We're looking for W2. We might want to end up with something like 1XX, which is another form of weight. We'll see when we work out the efficient frontier in our example of an Excel spreadsheet, how this whole analysis of a 1 minus X applies. Now coming to the portfolio risk. Here, portfolio risk, now we assume that now the portfolio has got 2 assets in this case. Now let's recall the cosine rule from high school, where the cosine rule we had something like A plus B minus 2 cosine AB. So in the same analysis, we can see that we first work out the W1 and then call W2. So the first variance and the second variance, but each one apportioned according to weight 1 and weight 2 of the portfolio. But now followed by this term, which is also statistically called a covariance term. So in this case, we will now have this as a covariance term, whereas these two are your variances. Okay. Alternatively, this formula could just be sigma of P equaling to W1 sigma 1 plus W2 sigma 2 plus W1 W2 rho 1 2 sigma 1 sigma 2. But there's only one problem here with this calculation. We're going to have a problem when we get here. That is why the best approach here is to first calculate it using the variance, so that when we apply the sigma p, we are able to get using the square root sigma p, which is a standard deviation, as a square root of a variance. This works out better. So, but all I was trying to demonstrate here is that this one actually means that we want to end up with a sigma 1 and sigma 2, which are standard deviation and standard deviation plus. But now we're going to struggle with our covariance term there if we do not have it, those two squares. So it's best to work with a variance and end up being able to combine this with the covariance term. Now, having done that, the next thing is to introduce a generalized form now, which is the multi-portfolio asset. Supposing here, instead of just n is equal to 2 like previously, we have rather many assets in this portfolio that we are considering. So now this is a portfolio of risky weights. Remember, we had a W1 and W2. But in a case of multi-asset, it will be W1, W2, W3, up to so many W's, depending on the number of assets from which each asset has to be allocated or share with in a risk weight of this entire portfolio. So now the correlation coefficient here is rho ij, which will demonstrate how it behaves when we introduce the covariance matrix later on. So now this notation here becomes something like this. Remember now, the very fact that we have a summation sign there, it means, as you can see, we add all the wi's and sigma i's. Thereafter, we add wj's and sigma j's. It could be many of them. But later on, we may add the covariance term, which is ij, and coupled with the sigma I, sigma j. But once again, everything must be in a square root, because as we've mentioned, we're using the variance here more than anything. We do not necessarily have the sigma squared in this one, but we have everything factored into this wi, wa, sigma I, sigma j, because now as we count some of the sigmas here, while we reiterating the calculation, we'll hit a stage where we have the sigma I and the sigma I. This could be sigma 1 by sigma 1, or it could be sigma 2 by sigma 2. So this will give you sigma 2 squared. That one will give me sigma 1 squared. Or we might even have sigma, let's say 10 by sigma 10. Then we'll now end up with sigma 10 squared. That is why we do not have the sigma squared just like we had with the earlier one. We will see when we introduce the covariance matrix that these variance, which has your sigma, will be lying in the diagonal. We'll have all your sigmas squared in the diagonal, whereas elsewhere it will be your sigma ij's. So now this will now be followed by us introducing the J rule for annualization of the volatility. Remember, in our workings, the first thing that we'll do is to work out returns, the daily returns, weekly returns, month, depending on which period we want to analyze. It will be just simply a series of returns depending on the length of a time series. But then thereafter, we need to summarize that statistic, meaning that we need to work out the average of your returns, but also work out the variance of those returns or even the standard deviation. But now here comes something to complete the word volatility. Loosely speaking, volatility is called a standard deviation. But the answer is that no, volatility itself is not standard deviation, but volatility is derived from a standard deviation, but in a sense that when you annualize it, it means now you need to factor in the period component of the trading data, so that now this could now be expressed as a percentage of your annual standard deviation. This now brings us to introducing the J rule. Some people can call it the I rule or whatever, or just a day period rule for volatility. Let's suppose we're looking at an annual volatility. It's now we're going to take this J period rule. Let's say we've calculated the standard deviation of the entire return to be about 5% or just 0.05. We need to adjust it. For if it was our daily data, we need to adjust it by 250 days. But remember that the standard deviation is already a square root of the variance. So, but we cannot now leave 2 as a square. It means that time must also be given into a standard deviation, so that we left with standard deviation multiplied by the square root of time period, which is now 250 days in this case. So basically now the J here could be a 1 day if we are looking at the daily data, which will obviously correspond to 250 days of a year, or even 252. Or it's a weekly data, which will correspond to the 52. Or it's a monthly data, which will be a 12. Or even a 1 year, which will be 1. So we have to sum up. If someone say no, volatility standard deviation, say no, I think I can explain it better to call it an annualized standard deviation is the meaning of the word volatility. Okay. Then the J period rule is the standard deviation of returns over a J period. That's what it is. Not just standard deviation of returns without analyzing it. So in other words, the word volatility is coupled with the period of trading or the timing of your trading. Thank you. I hope you enjoyed this session with us, and the next thing will be the examples on the Excel application. I am the financial modeling teacher. Thank you.